25%. Not a projection, not a worst-case scenario, not some fringe economist's fever dream scrawled on a whiteboard at a doom conference nobody attended. 25% cumulative inflation in 5 years, verified, confirmed, measured, and reported by the Bureau of Labor Statistics, the same government agency that is supposed to be reassuring you, not terrifying you. That means if you had $10,000 sitting in a standard savings account in January of 2020, the real purchasing power of that money, what it can actually buy you today in the real world, at a real grocery store paying real rent, has been silently, systematically, and irreversibly reduced. The number in your account might look the same, but the money isn't the same. It never will be again. And here's what they don't want you to focus on. It's getting worse. Not better, worse. Right now, as you watch this video, inflation is re-accelerating. The CPI, the Consumer Price Index, the government's primary measuring stick for how fast prices are rising, just posted a 3.3% year-over-year increase for the 12 months ending March 2026. And in a single month, March alone, prices jumped 0.9%, the largest monthly surge in nearly 4 years. Let me break this down. The Federal Reserve spent the better part of 2 years telling the American public that inflation was under control, that the hard work had been done, that the corner had been turned, and for a brief, optimistic moment, it almost looked true. Headline inflation had dropped to 2.4% as recently as February 2026. People exhaled. Markets rallied. Economists smiled on cable news. Then March happened, and everything changed. This is not a blip. This is not a seasonal adjustment. This is a signal. And if you understand what that signal means for your paycheck, your savings account, your retirement fund, your mortgage payment, your grocery bill, and the long-term financial security of your family, you need to stay right here for the next several minutes. Because what we're about to walk through isn't just bad news. It's a crisis hiding in plain sight, dressed up in government statistics and Federal Reserve press releases, while millions of ordinary Americans feel the squeeze and wonder why nobody is telling them the full truth. We are going to tell you the full truth, right now. There is a concept that most Americans were never taught in school. It doesn't appear in most personal finance courses. It's not on your bank statement. And yet it is arguably the single most important force shaping your financial life right now. It's called purchasing power. And the dollar, your dollar, is losing it at a rate that should alarm every single person watching this video. Here's how purchasing power works, stripped of all the jargon. The dollar in your pocket doesn't have a fixed value. It never did. What it buys, what it's actually worth in the real, tangible world of goods and services, is constantly shifting. When inflation rises, each dollar you hold becomes worth less. Not worthless, less. Incrementally, quietly, without any announcement, without any notification from your bank, without any alert on your phone. Think about what that means in practical terms. If you had $100 in January of 2020 and you locked it in a drawer, didn't spend it, didn't invest it, just held it, that $100 has lost roughly 24 to 26 cents on every dollar in purchasing power over the last 5 years. You still have $100, but you can buy what $76 used to buy. The money didn't go anywhere. You didn't lose it in the stock market. Nobody stole it from you in any conventional sense. But through the slow, invisible mechanism of inflation, a fraction of its value evaporated every single year, every month, every week, while you weren't looking. Now multiply that across an entire economy of savers. The Federal Reserve's own data tells us that the personal saving rate in the United States sat at just 3.7% as of mid-2025. That is catastrophically low. Before the pandemic, the saving rate averaged somewhere around 7 to 8%. During the pandemic, it briefly spiked. People had nowhere to spend money and government checks were landing in bank accounts. But then inflation hit, and savings were consumed. Not by choice, by necessity. Let me be very direct about what that 3.7% saving rate means. It means the average American household is setting aside less than 4 cents of every dollar it earns. After taxes, after rent, after groceries, after utilities, after car payments, after insurance, after debt service, less than 4 cents on the dollar is being saved. And even that pathetically thin margin is being eaten alive by inflation running at 2.6%, 2.9%, and now 3.3%. Here is the ugly arithmetic that nobody in Washington wants to show you on a graph. The average savings account in America, the basic standard brick-and-mortar bank savings account where most ordinary households park their emergency fund, pays an annual percentage yield of approximately 0.42%. Not 4%, not 40%, 0.42%. Inflation right now is running at 3.3%. That means if your money is sitting in a standard savings account, you are losing approximately 2.88 percentage points of real purchasing power every single year. Not gaining, losing. Your bank is giving you a fraction of a percent while inflation devours the remainder. Your money is shrinking while sitting completely still. This is the dollar illusion. The number in your account doesn't change, but what it represents, what it can actually do for you in the physical, material world, is being systematically reduced. And the American financial system is structured in a way that makes this invisible to most people, right up until the moment they try to retire, or cover a medical emergency, or buy a house, and they realize the money they thought they had isn't the money they actually have. This is not a conspiracy. This is arithmetic. And the arithmetic is brutal. Let's bring this out of the abstract and into something you interact with every single week. Food. The grocery store. The one place every American, regardless of income, regardless of zip code, regardless of political affiliation, has to visit. And for the past 5 years, that grocery store has been one of the most visible and visceral battlefields in the inflation war. According to data compiled and analyzed by the American Progress Research Organization, the average American family of 4 spent approximately $8,300 more on food during the post-pandemic inflation period than they would have at pre-pandemic price levels. That's over $8,000 additional dollars, extracted from family budgets, silently, across the grocery store aisles. Think about that number. $8,300 is a car payment. It's a semester of community college. It's an emergency fund. It's a down payment contribution. It's money that could have gone toward retirement savings, toward debt reduction, toward a child's future. Instead, it went to the grocery store. Not because families were eating better, not because they upgraded their diets, simply because prices went up. And they went up fast. At its worst, in August of 2022, grocery inflation hit 13.6% annually, the highest rate in 4 decades. And not just overall grocery prices, specific categories were being absolutely hammered. Rice, one of the most basic essential food staples on the planet, rose 20% over a 4-year period. Eggs became a national news story. Beef prices surged. The items that working-class and middle-class families depend on most, the staples, the proteins, the basics, were the ones hit hardest. Now here's what they tried to tell you when inflation started cooling. They said, prices are stabilizing. Grocery inflation is down. Things are getting better. And technically, the rate of increase slowed. By 2024, annual grocery inflation had moderated to somewhere around 3.1%. That sounds much better than 13.6%. But here's what they didn't tell you. Prices don't go back down just because the rate of increase slows. When something that cost $1 in 2020 rises 13.6% in 1 year, it cost $1.13 the next year. When the rate slows to 3%, it's now $1.17, then $1.20, then $1.24. The baseline keeps climbing. Moderation doesn't mean relief. It means the pace of pain slows, but the pain itself continues to compound. And in 2025, new pressures arrived to make things worse. The tariff wave of 2025 introduced a new layer of cost pressure directly onto American families. Research from Harvard Business School, tracking over 350,000 goods, found that tariffs raised the Consumer Price Index by 0.7% since March 2025. That may sound small in isolation. In aggregate terms, it translated to an additional $1,000 to $1,300 per year in costs for the average American household. Think about that carefully. A family already stretched by 5 years of cumulative inflation, a family that had already absorbed the $8,000 food price surge, that was already living on a 3.7% saving rate, got hit with another $1,300 in annual costs. Where did that money come from? It came from savings that were already thin, from credit cards, from retirement accounts, from the future. And according to NerdWallet's data on food prices, groceries were up 2.4% annually on a food-at-home basis as of early 2026, with overall food up 3.1%. This on top of everything that came before. The baseline never resets. The accumulation never stops. Low-income and middle-income households, the ones spending the largest share of their income on food to begin with, feel this the hardest. When a family earning $50,000 a year is spending 30 to 40% of its take-home pay on groceries and food, a sustained period of 3 to 13% annual food inflation is not an inconvenience. It is a financial catastrophe playing out in slow motion, one grocery receipt at a time. If inflation at the grocery store represents the slow bleed, housing represents the hemorrhage. The American dream, home ownership, the 30-year mortgage, the backyard and the white fence, has always been central to the national identity. And right now, that dream is more financially out of reach for more Americans than at any point in modern history. Let's look at the numbers with clear eyes. The median price of a new home in the United States reached approximately $459,826. Call it $460,000. According to data from the National Association of Home Builders, under standard mortgage underwriting rules, the conventional guideline that housing costs should not exceed 28% of gross income, 75% of American households cannot afford that median-priced new home at current interest rates. 75%. 3 out of every 4 American households are priced out of the median new home. And it's not just new homes. 76 million households, representing 57% of all U.S. households, cannot afford a home priced at $300,000, not $460,000, $300,000. A home that in many major markets would be considered quite modest. 2 decades ago, home prices were typically 4 to 5 times the median household income. Today, that ratio has stretched to 6 times income, and in high-cost metropolitan areas it goes far beyond that. The mathematics of home ownership have fundamentally changed, and they changed during the inflation era in ways that haven't reversed. Here's why it happened, and why the pain persists even as broader inflation has moderated. When the Federal Reserve started raising interest rates aggressively beginning in 2022, hiking from near zero to over 5% in one of the most rapid tightening cycles in American economic history, mortgage rates skyrocketed. The 30-year fixed-rate mortgage, which had sat at an all-time low of 2.93% just years before, climbed to above 7% and has since settled around 6.25%. Do the math on what that means for a family buying a $500,000 home. At the record low rate of 2.93%, the monthly principal and interest payment was approximately $2,089. At today's rate of 6.25%, that same mortgage costs $3,079 per month. That is a difference of $990 every single month. Nearly $1,000 a month more, not because the house got bigger, not because the neighborhood got better, not because anything changed about the physical property itself, simply because of where interest rates are. That $990 monthly difference is $11,880 per year. That's a car payment. That's a college tuition contribution. That's what stands between millions of American families and home ownership. And it is a direct consequence of the inflation environment we have lived through. Now turn to the rental market for anyone who thinks renting is the escape hatch. Median gross rent in the United States reached $1,487 per month in 2024. Rents have risen 50% since 2017. Wages over that same period rose 38%. That gap, 12 percentage points where rent outpaced earnings, represents an enormous and growing burden on every American household that rents its home. And the majority of low-income renters, 90% of families earning under $20,000 a year, are now classified as cost-burdened, meaning they spend more than 30% of their income on housing. 30% is the line that economists and housing experts use as the threshold above which housing is considered unaffordable. And 90% of the poorest renters are above that line. For middle-income renters, those earning between $20,000 and $50,000, 60% are spending more than 30% of their income on housing. Even among people who would describe themselves as solidly middle class, housing has become a financial anchor pulling them downward. And here is what ties all of this back to inflation. Shelter costs, the cost of putting a roof over your family's head, make up the single largest component of the Consumer Price Index. It's not food, it's not gas, it's housing. Which means when shelter costs keep rising, even as other categories cool, overall inflation remains stubbornly elevated. And when inflation remains stubbornly elevated, the Federal Reserve keeps interest rates high. And when interest rates stay high, mortgage rates stay high. And when mortgage rates stay high, home prices stay unaffordable. This is not a cycle that resolves itself quickly or painlessly. This is a structural problem, and it is getting worse. There is a category of spending that every American has no choice about. You can stop buying luxury goods. You can eat out less. You can delay a vacation. You can drive an older car. But you cannot stop using electricity. You cannot stop heating your home in winter. And for most Americans, you cannot stop driving. Energy. It is the non-negotiable expense. And its price trajectory over the last several years should concern every household in this country. Let's start with electricity. According to data analyzed through the Wolf Street research platform, the Consumer Price Index for electricity surged 6.7% year over year and has climbed a staggering 41% since January 2020. When you adjust for inflation in 2025, national electricity prices increased 3.9%, well above the general 2.7% inflation rate. In some regions, like the Midwest, the inflation-adjusted electricity cost increase was 8.5%. Overall energy, the aggregate basket including electricity, natural gas, and fuel, has risen 29% since January 2020. That means a household that was spending $200 a month on energy in January 2020 is now spending approximately $258 a month, a difference of $58 per month, or $696 per year, just to power, heat, and cool the same home, living the same life. Natural gas utility prices increased 4.9% from December 2023 to December 2024, after a brief period of decline. Home heating costs are projected to increase 9.2% in the most recent heating season, more than 3 times the general rate of inflation. For families in cold weather states, that is not a statistic. That is hundreds of additional dollars being diverted from savings, from groceries, from retirement contributions, just to keep the heat on. And gasoline? While pump prices have declined from their 2022 peaks, and that decline did contribute to cooling overall CPI, gasoline prices remain substantially higher than pre-pandemic levels. And in the most recent CPI report for March 2026, energy costs came surging back, up 12.5% on an annual basis, with gasoline up 21.2%. That's not a typo. Gasoline prices year over year up more than 20%. That single category, the cost of filling your tank, explained a significant portion of the single-month CPI spike of 0.9% that alarmed economists across the country. Here's what that means on the ground. Data from a Dayforce study cited by CBS News found that full-time workers reduced their 401k contribution rates to 8.9% in 2025, down from 9.2% in 2024, the first decline in contribution rates since tracking began. Researchers specifically identified higher energy costs, including gasoline adding roughly $740 per year to household budgets, as a key reason workers were pulling back from retirement savings. Think about the compounding nature of that decision. When a worker reduces their 401k contribution, even by a fraction of a percentage point, the long-term consequences are not linear. They are exponential. Over a 20 or 30-year career, that small reduction today translates to tens of thousands of dollars less in retirement. A worker making that choice to cut retirement savings today so they can fill their gas tank isn't making a financial mistake. They're making a survival decision. And the system that forced them into that survival decision, persistent multi-front inflation across energy, food, and housing, is still operating at full force. The energy vice is not loosening. And for millions of Americans, the choice it creates is unbearable. Heat your home or save for retirement. Fill the tank or build an emergency fund. The inflation system should not be putting American families in that position, but it is. When inflation erodes purchasing power faster than wages can compensate, people do not simply cut their spending and accept the reduced standard of living. They borrow. They put it on the card. They tell themselves it's temporary, that they'll pay it off next month, that things will get better. And in small individual doses, that behavior is understandable, even rational. But multiplied across 111 million Americans, it becomes a systemic catastrophe. Total U.S. credit card debt reached $1.277 trillion by the fourth quarter of 2025. That is a 66% increase from the pandemic-era low of $770 billion in the first quarter of 2021. It is 38% above the pre-pandemic peak of $927 billion. The speed of that accumulation is staggering, and it tracks almost perfectly with the onset and persistence of the inflation era. 111 million Americans, approximately 40% of all U.S. adults, and roughly half of all credit card holders, carry balances from month to month that they cannot pay off. Not rolling balances they're actively managing down, balances they're stuck with, balances that grow. 27 million of those Americans are making only the minimum payment, and at current credit card interest rates, which average 24.84%, a minimum payment barely touches the principal. For millions of households, that debt is essentially permanent. It accumulates, it compounds, it grows in the dark, invisible to official economic statistics, but absolutely visible at the kitchen table. Let me put 24.84% in context for you. A mortgage, a secured loan backed by a physical asset, charges around 6.25%. A car loan runs somewhere between 7 and 10%. But credit card debt, the financial product being used by millions of Americans to cover their groceries, their utility bills, their gas, their basic living expenses because inflation has outpaced their income, charges nearly 25%. That is the most expensive common form of consumer debt in the economy. And that is precisely what America's working and middle class has been driven into as a consequence of 5 years of relentless inflation. 60% of American adults used credit cards to buy groceries in 2023. That's not a statement about reckless spending. That's a statement about how badly inflation has squeezed household cash flow. When the grocery bill rose 13% in a single year while wages rose 4%, something had to give. For 60% of Americans, what gave was the credit card limit. They charged the groceries, they paid the interest, and the debt accumulated. By the second quarter of 2024, credit card delinquency rates had climbed to 7.18%. That means more than 7% of all credit card balances were 30 or more days past due. Nearly half of all loan applicants, 48%, were denied credit between December 2023 and December 2024, a credit market tightening that was itself a direct consequence of high interest rates. The debt spiral works like this. Inflation erodes purchasing power. Households borrow to maintain their standard of living. High interest rates, the Federal Reserve's primary weapon against inflation, make that debt more expensive. The more expensive debt becomes, the larger the share of household income consumed by debt service. The more income consumed by debt service, the less available for savings, retirement, emergency funds, or consumption. The reduction in consumption slows the economy, which creates pressure for the Fed to cut rates. But cutting rates too soon risks reigniting inflation. Which brings us back to the beginning. This is the trap. And 40% of American adults are already caught in it. We need to stop for a moment and talk about the most fundamental measure of financial security: the ability to absorb a single unexpected expense. Because what inflation has done, over 5 years across every spending category, is strip away financial buffer from tens of millions of American households. It has thinned the margin between stability and crisis until, for a terrifyingly large number of families, that margin is effectively zero. 56% of Americans, more than half the country, cannot cover a $1,000 emergency without going into debt or liquidating assets. Not a $10,000 emergency, a $1,000 emergency, a car repair, a medical copay, a broken appliance. One unexpected event costing $1,000 would push more than half of all American households into financial distress. That is not a statistic about poverty. That is a statistic about inflation. About 5 years of costs running faster than savings. About a financial system that has delivered a 0.42% return on savings accounts, while inflation ran at 3, 4, 5, and 9%. About real wages that, while showing recent improvement, still haven't fully compensated for the purchasing power losses of 2021 and 2022, the worst inflation years in 40 years. A research report from the blog Ontic, citing data on the American savings crisis, found that middle-income cash cushions have dropped by 42% since 2022. Not by a few percent, by nearly half. The financial buffer that middle-income families had built, not the wealthy, not the poor, but the middle, has been cut in half in 3 years. The Ludwig Institute for Shared Economic Prosperity published research finding that the true living cost, the comprehensive measure of what it actually costs to maintain a basic American life, rose 31.3% from 2019 to 2024. That's 5.6% annually. The costs of a basic American life rose 5.6% per year for 5 consecutive years. Meanwhile, median wage growth over that period was 3.9%. The gap, 1.7 percentage points per year compounding, represents the systematic ongoing erosion of middle-class purchasing power that official headline inflation numbers consistently understate. Bank of America's Institute, one of the most comprehensive sources of real-time consumer financial data in the country, given the institution's visibility into millions of actual household accounts, found that approximately 25% of all U.S. households are living paycheck to paycheck in 2025. Among lower-income households, that figure rises to 29%. Among lower-income millennials and Generation Z, the numbers are even more alarming, with the share continuing to climb year over year. Think about what living paycheck to paycheck actually means. It means there is no slack in the system, no buffer, no margin for error. It means that if inflation spikes unexpectedly, as it just did in March 2026, by 0.9% in a single month, those households have no cushion to absorb it. It means that if a medical bill arrives, or the car breaks down, or the rent goes up, the response is not to dip into savings. It's to go deeper into debt, to take a 401k loan, to fall behind on a payment, to make the kind of financial decisions that create cascading consequences. And this is before we account for what is coming next. If the erosion of purchasing power is a crisis for working-age Americans, it is an existential threat for those approaching or already in retirement. Here is a truth that most financial news coverage does not emphasize with sufficient urgency. Inflation is uniquely severely damaging to those living on fixed incomes. And in America, fixed income, Social Security, pension payments, annuities, and the returns from conservative savings instruments is precisely how tens of millions of retired Americans survive. The Social Security Administration announced a 2.5% cost of living adjustment for 2025. For the average Social Security retirement beneficiary, that translated to approximately $50 per month more. $50. Meanwhile, the Consumer Price Index was running at 2.7% for most of 2025 and has now jumped to 3.3%. The COLA, the mechanism specifically designed to protect retirees from inflation, was already below the actual rate of price increases before inflation re-accelerated in March 2026. And that gap between what Social Security COLA provides and what inflation actually demands compounds remorselessly. When COLA falls short of real inflation by even a fraction of a percent each year, the real purchasing power of Social Security benefits is quietly, constantly being reduced. A retiree who is receiving $2,000 a month in Social Security benefits in 2020 has seen those checks increase on paper through annual cost of living adjustments, 5.9%, then 8.7%, then 3.2%, and now 2.5% for 2025. But in real inflation-adjusted terms, the purchasing power of those benefits has not kept pace with the actual rise in the cost of living. Each year that the COLA comes in below true inflation, below the real increase in what it costs to buy food, pay rent, cover utilities, fill prescriptions, and keep a car on the road, that retiree loses a little more ground, permanently. There is no make-up mechanism. There is no retroactive adjustment that restores what was lost. Once a year passes in which inflation outpaces the COLA, that gap is locked in for the rest of that retiree's life. The check may get bigger in nominal dollars, but the life it can actually support gets smaller. Now zoom out from one retiree to an entire generation. Roughly 71 million Americans receive Social Security benefits. For a majority of retirees, those benefits are not supplemental income. They are the core of their financial survival. 1 in 4 retirees relies on Social Security for at least 90% of their income. For many, it is effectively all they have. When inflation quietly, relentlessly erodes the real value of those benefits, the consequences are not theoretical. They are visible in skipped medications, in postponed medical appointments, in meals stretched a little thinner at the end of the month, in thermostats turned down in winter and up in summer to shave a few dollars off the utility bill. This is what it means in human terms when we talk about a 2.5% COLA in a 3.3% inflation world. It means that every year millions of older Americans are asked to do more with less, to maintain dignity, health, and independence on a shrinking real income, in an economy where every essential category of spending has become more expensive, and none of them are optional. And if you think this is just a retiree problem, you're missing the larger point. Because the same forces that are eroding the purchasing power of Social Security checks are eroding the purchasing power of your paycheck, your savings, and your future retirement, right now. The gap between what life costs and what your income can buy is not going to magically close when you turn 65. If anything, it widens. So if you're in your 30s, 40s, or 50s, and you are feeling squeezed today, understand this. Unless something changes in how you earn, save, invest, and protect your money, that squeeze does not ease with time, it tightens. Which brings us to the question that should be in your mind right now. What do you do about it? You cannot vote away inflation. You cannot tweet it away. You cannot wish it away. You cannot rely on the Federal Reserve to perfectly calibrate interest rates so that your savings are protected without your borrowing costs rising. You cannot depend on Congress to suddenly become fiscally disciplined after decades of debt accumulation and deficit spending. You control exactly 3 levers in this environment: how much you earn, how much you keep, and where you put what you keep. You earn more by increasing your skills, your value, your leverage in the marketplace, by becoming harder to replace and easier to reward. You keep more by ruthlessly cutting the financial friction in your life. High-interest debt, unnecessary subscriptions, lifestyle inflation, bad insurance, overpriced products, and fees that quietly skim your income before you ever see it. And you protect and grow what you keep by refusing to let it sit where inflation can eat it alive. By moving idle cash out of 0.42% accounts and into instruments that have a fighting chance of outpacing inflation. By building real emergency reserves so that an unexpected bill does not become a credit card balance at 24.84%. By investing consistently, even in small amounts, into assets that historically grow faster than the cost of living over long periods of time. None of that is easy. All of it is necessary. Because the era we are living through is rewriting the rules of what it takes to stay financially afloat in America. The old assumptions, that a simple savings account is safe, that modest annual raises will preserve your standard of living, that Social Security will comfortably cover retirement, have already been broken. The data is in. The experiment is over. Inflation won. The only question now is whether you are going to keep playing by the old rules in a new game, or whether you are going to adapt. In the next part of this series, we're going to show you exactly how to adapt. The specific steps to audit your finances for inflation risk. Restructure your debt so it stops working against you. Reposition your savings so it starts working for you. And build an action plan that gives you back something inflation has been stealing from you for 5 straight years. Control. If you are tired of watching your money quietly lose value while you work harder than ever just to stand still, do not miss what comes next.